You do not want to miss this episode. We're going to break down Nelson Nash book, Becoming Your Own Banker, page 41 to 47, how to start building your own banking system. We're going to look at the different ways to finance a purchase, compare 5 different methods, and see which one's the best. Hi, everyone. Welcome to Control and Compound with Darren Mitchell. I'm your host. Joining me, as always, Christina Wyatt. Christina, how you doing today?
Hey Darren, I'm doing awesome. Super excited to dig into another chapter of Nelson's book.
Yeah, we're talking about purchasing with 5 different methods, and again, some of these methods or some of the numbers in the book might seem outdated, but if they worked then, they're going to work now. We're just the numbers will get bigger. Cars are more expensive than they were when Nelson wrote the book. But the goal of this is just the concept of explaining the different methods, and then talk reasonably and logically about what would be the best method.
Exactly. But before we jump in, I just want to remind everybody, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. If you're listening on YouTube, please like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on our socials at Control and Compound on Instagram and TikTok. So before we jump in, I just want to let everybody know that we are referencing, if you've got a copy of Becoming Your Own Banker, we are referencing pages 41 to 47. The chapter is How to Start Building Your Own Banking System. But first, Nelson does a very good job at explaining the traditional financing systems that the regular person is using today, and then showing us how much better we can make it by using our own financing system, being your own bank. So let's dig into it, Darren.
Sure. So there's five methods Nelson talks about in this chapter. The lease method, you lease a car. Then he talks about the bank method, where you finance a car. He talks about a cash method, where you save cash every year until you've saved enough to go buy a car and pay cash. Then he has the CD method. CD, Canadian equivalent would be GIC. So save in a GIC so you're earning some interest and buy a car that way. And then the final method is using the infinite banking concept. So let's start with the lease method, Christina. The lease and the bank method are pretty similar, but the lease method, we all know what a lease is. Typically, you go in, don't have to come up with any money up front. You have a monthly payment. You're able to get the car right away. You get a fancy new car, hopefully for a relatively low payment. You think you're winning here. At the end of 4 years, you turn the car in, assuming you didn't go over your kilometers or miles. You turn the car in, and then you lease another one. Now, when we compare the leasing method to the bank financing method, what are the key differences Nelson talks about? Or Nelson just kind of breaks it down and says, logically, if you think of this, the bank method must be better than the leasing method. Why?
Well, because you own that asset at the end. So Nelson kind of digs in there. At the end of every 4 years, you can, with the financing method, you can take that car, sell it, put it towards the next vehicle. So instead of just, having the owner of the vehicle in the financing situation earn that asset and have that extra, you're going to be doing it by financing. So logically, the financing, and he does put numbers out there, but like you said, Darren, I don't think we even really need to dig that much into the numbers, because logically thinking, if you're financing a vehicle, you're not going to own the asset at the end, so you're not going to be able to take those funds, put them towards the next asset in those 4 years. Now, I know what you're thinking if you lease a vehicle and you're a business owner, and there's lots of reasons why you might be leasing a vehicle, and there's lots of reasons why you're absolutely right. This is just going to show you a couple of different ways, very standard, somebody financing versus leasing a vehicle, no tax write-offs and everything else. And if we look at it that way, the financing does come out better because you have that asset, right? Not much better, but a bit better.
Yeah, so if you think of it, if you lease a car, someone has to own that car, and that's not you. And whoever owns that car, whether it's an individual or probably a large corporation, well, that corporation or owner of the vehicle, they want to make money. They're not going to do this because you're a nice person and they want to lease your car. They're going to need to make money, and they're going to make money as the owner. So there's going to be a spread for the owner. And then if you buy the car outright, well, you don't have that extra player in the game that needs to get a piece. So you'll be able to get all the pieces of that, make some money on that, or make a little bit more money, because on a lease, logically, the owner has to make money. Now, again, you mentioned business owners and tax write-offs, so we're not going to get into that. There's sometimes there's reasons why you'd want to lease, but if we kind of stick to reviewing Nelson's book, It's the bank method. Financing is better because you're the owner and you have a trade-in value.
Exactly. So the next method that he gets into is another more traditional route that we see the majority of people might use is the paying cash, right? So this one takes a little bit longer. You don't get your car immediately. You can't walk on the lot and get it. You've got to decide how much you're going to spend on that car, and then you're going to save up over the next, in his example, 4 years. You're going to save up for that vehicle, and then you're going to pay cash. And as you are driving that car for the next 4 years, you're going to save up that car payment, and again, you're going to pay cash. So you're eliminating that financing aspect here on the other end, right? You're not helping yourself so much, but you're not helping others either at this point in time, right? You're not paying out that financing charge. So that would be like the three traditional ways of financing or purchasing a vehicle. And this one gets better, right? So it does look better because of the fact that you're not paying that interest out to somebody else.
Yeah, so you're slightly above zero. Nelson's chart on page 41. It's actually a little confusing when you look at this because it's kind of like a 3D picture tried to be put on a 2D piece of paper. So the lease method and the bank method, if you look at that chart, you're actually underwater, right? Which makes sense. You've leased this payment, and now at the end of it you have nothing. So you've paid out, you have nothing, or you've bought a vehicle and it's depreciated in assets, so you've actually paid more than the vehicle is worth. So you're underwater. The cash method, at the end of the day, you're slightly above that zero line. You've saved money in your savings account. You might get a couple nickels of interest, so you might be slightly above that zero line. But the fourth method, he gets into where instead of just saving in a bank account, why don't we take that money we're saving and put that into some kind of guaranteed investment, so we're going to earn interest. And he calls it a CD. In Canada, the equivalent would be a GIC. So the fourth method is we're saving money in a GIC, and is it 7 years, I think they take before they buy a car in that method? So they save money in a GIC, and then they pay cash for a car, withdraw it from the CDs. Save again, start saving right away, save it in a GIC, take money out to buy it. So that's the GIC method. Anything else on the GIC method I missed, Christina?
Yeah, he uses the 7 years because if you look at how long it typically takes for a business to get going and to start making and earning, it's about that 7 year period. So Nelson's always comparing, this to establishing a business, making your own bank. It's going to take those 7 years. It's going to take the time to get going, which is why he gives it that 7 year period of that interest being earned inside the account.
So if we do the GIC method, there's another factor we need to consider.
Yeah.
What's
so
that?
we start talking about those laws again. So he says you defeat Parkinson's law, right? You've done it differently. You're going against the herd. You're going to do better. But anytime that you're doing better, there's another player that comes into it where we bring back Willie Sutton's law. So that other player in Canada is CRA, right? You start doing better, they're going to want a piece of the pie, which is exactly what happens when you start using those GICs. You're going to be fully taxable on those GICs as they come up. So you're not really earning, he used a 5.5 in here. And right now, actually, you can get about 5.5 in some GICs, not all the time. But yeah, they're going to take about half or so when you're using this method. So Willie Sutton's law comes into place very quickly.
Yep, they asked Willie Sutton, Willie, why do you rob banks? And he goes, that's where the gold is. And CRA works the exact same way as Willie Sutton. Why do you attack? Why do you attack or take from people that earn money? Well, that's where the gold is. So if you're earning money on a GIC, Willie Sutton, or in this case CRA, is going to come in and go, oh, let's steal some of that, or sorry, pay your fair share of some of that interest. So they're gonna take that. So yeah, 40-50% interest on that. So you're gonna gain, but then you're gonna pay CRA.
Exactly. So our last and our fifth method that he brings in, no surprise here, is we're going to use the infinite banking concept, right? So instead of setting up that GIC, we are going to save inside of our high cash value life insurance policy, that dividend paying high cash value policy that we use. And he's going to use the same timelines. We're going to deposit into our policies over that 7 year period. So we're going to deposit over the 7-year period. And then now in Nelson's examples here, he does like to use withdrawals in the first bit. And I'll tell you why. And I fully agree with his why he did it this way. It's because the moment people hear the word loan, they panic and they freak out. And they're like, I'm not a loan. I'm not loaning my own. I'm not borrowing my own money. So what he's done here is he has used withdrawals just to prove his point that it's still going to work very well, even if you do the withdrawals. So it'll get better if we use policy loans, but he's showing an example of using those withdrawals for the for those cars after the 7 years, and then every 4 years replacing those vehicles, and what that looks like. And it does look very comparable to the GIC in those first years. Actually, the GIC or the guaranteed kind of looks a bit better in those first years, because it does take a little bit longer to get going. But in the later years, that's when we see the true difference in what happens between these two different accounts, right, Darren?
Yeah, so he compares the two sisters, and the one sister does the CDs or GIC equivalent, and the second sister does the infinite banking concept. So if you think of this logically, if you have a cash value life insurance policy that's compounding, well, that's going to compound completely tax-free. So we've eliminated that Willie Sutton or CRA stealing our money. So that's going to compound tax-free. And if you look at the long-term implications of that, both from the cash value and from the death benefit, when you hit retirement, so Nelson talks about a 44-year period where they bought their 11 cars and now they're retired, and they compare what the CD sister has, or the GIC sister, versus the infinite banking concept. And the sister with the GICs, they have about $250,000 when they're all finished buying their 11 cars, because they earned some interest, paid some tax, earned some interest, paid some tax, but they got about $250,000. So Nelson gives the example, okay, well, this person can take the $250,000 from their CDs and withdraw about $50,000 a year for about 5.5 years before they're completely out of money. So at the end of that 5.5 years of retirement, hopefully they died so they won't be poor. No, but basically at the end of 5.5 years, that sister is out of money, no life insurance, no cash, no retirement income. End of story. Still better off than the other methods. We talked previously about the cash and the financing, but still, 5.5 years of retirement doesn't sound great. If we look at the infinite banking concept with Nelson's number, we can take that $50,000 withdrawal out for 13 years. Now that again, that's actually taking the withdrawals. If Nelson illustrated policy loans, and he talks later about should be using policy loans. If we did policy loans, it'd be a lot more than 13 years. Maybe it'd be closer to 20 years that you could take out with policy loans. But regardless, in his example, 13 years of an income in retirement of 50,000 versus 5.5. Which one do you want? Do you want an income for 13 years or 5.5? So obviously, you're going to be better off with the infinite banking concept versus saving in the GIC. But then the other big one is, we haven't really focused on the life insurance death benefit here. We are buying cars in this example. But with the infinite banking concept and a high cash value life insurance policy, you're going to have a death benefit. And the death benefit in this case, even after they spent that $50,000 a year for 13 years, there's going to be about almost $1.4 million of death benefit. So if you just stop and think of this, so do you want to buy a car every 4 years in the GIC method and have 5.5 years of retirement at 50 grand? Or do you want to buy, with the infinite banking concept, have 13 years of this tax-free income plus leave $1.4 million to your family? So really no comparison on those two. And again, just a simple comparison. We're not getting into all the other things we could do with that death benefit because, Christina, we love death benefit. We're focused on cash value, but when come retirement time, death benefit is magical for people that have it. When I have a large death benefit, when I get close to retirement or retired, I don't mind refinancing all my income properties and spending that, dying with mortgages. Who cares if there's a big death benefit? I don't mind getting a line of credit on my house for 50 or 100 grand a year in my 70s to top up my retirement lifestyle because my death benefit's going to take care of those loans. So over and above the example Nelson gives, there's all kinds of additional things we could do to really make the infinite banking concept a million times better than saving in a taxable environment in GICs.
Yeah, and you talk about that death benefit. Another key point he doesn't mention in the book, but on that side of things, you've had a death benefit since day one, too, right? Like
Yeah.
if you've got that financing out with the bank, or if you're paying for it and something happens to you, that financing still needs to get paid. With this, you've got a death benefit from day one built into it as well, which is great. Like we love that. So that's an extra value add, like you said at the end. And the other thing he talks about, that perpetual tailwind, so creating that environment, and we talk about that a lot with our snowball, right? So he kind of does the tailwind, we talk about that snowball. In the early years, we're rolling that snowball. It's not huge, but by the time you get out to those later years and we've got that uninterrupted compounding inside of this policy, we've created the tailwind, we've created that snowball that's just going. With the withdrawals, you don't see it as much. The numbers, if you're looking at the numbers, you don't see it as much because you're messing up that uninterrupted compounding, right? You're breaking it. But typically not typically, always in any illustration or any strategy we're going to build, you're going to use those policy loans, and that compounding is really going to increase in those later years. And you've built that by starting at that beginning and sticking through it and building out the business, right? And structuring your banking system, which is essentially what he's talking about. Instead of just doing one thing with your money, purchasing a car, why don't we use the and asset and have our money doing multiple things? Like in this case, it's purchasing a car, but we know we love to use it for our real estate. We love to use it for all of our other investments, and it's great for emergencies. It's great for investments, but it just shows that instead of having your money doing one thing, why don't we have it do more? Why don't we act like the banks and multiply those returns, right?
Yeah, and Nelson did a great job in this chapter, like illustrating this, and he kept it simple. But you mentioned some great points, like that death benefit day one. That's pretty cool. And if you look in the mid to later years on this, there's a real spread between your cash value and your cash in a GIC. So with that spread, I mean, we're just talking about cars, but if you have a couple $100,000 extra of cash value, 20 years down the road, well, maybe you want to buy an income property. Maybe there's an amazing opportunity when something drops in price, and you can do that, because there's no illustration in here, or there's no example in this chapter where he says, well, what about that spread between what the GIC is worth I'm saving for the cars and the cash value life insurance? Well, if I can borrow $100,000 and go do a private lend, or I can borrow $100,000 and go do a real estate deal, well, again, it's plus. It's more of that and asset. We're going to have death benefit. We're going to be able to spend our money differently in retirement. We're going to have a much larger retirement just from withdrawals in his example, or loans in our example. Plus, we're going to have an opportunity to do a bunch of other and opportunities, whatever your and opportunities are. So, you start multiplying this out through the years, and the spread gets bigger and bigger and bigger. We do policy loans instead of withdrawals. The spread's going to get bigger and bigger. So if you think these numbers are big, the numbers can actually be a lot bigger if you utilize all the features of the infinite banking concept.
Absolutely. But I think he does I do think he does a really good job breaking down some of the traditional ways of thinking and having you think outside the box, which is exactly what his book's all about, right? Thinking outside the box and, looking at those other strategies and what we can use. And obviously it goes to show in this one, the high cash value dividend paying life insurance policy definitely comes out on top between the methods.
Love it. Okay, so that was our page 41 to 47 review of the Nelson Nash book, Becoming Your Own Banker. If you haven't read the book, we highly recommend you get a copy and read it. That's it for today. Thanks for watching. Thanks for listening. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controlandcompound.com, and you can sign up for an education session with one of our wealth coaches.